There is a unique and challenging crossroads that every individual eventually reaches, a point in life typically arriving somewhere after the age of 50. It is a moment of profound financial reckoning. The distant horizon of retirement suddenly appears with an unnerving clarity, and with it comes a powerful mixture of hope and anxiety. For decades you have worked, saved, and invested, building a nest egg that is meant to provide security and freedom in your later years. But now, with the finish line in sight, the game changes. The rules that governed your earlier life of accumulation no longer seem to apply, and the world of finance, with its endless noise and conflicting advice, becomes a source of immense confusion and fear. The financial media bombards you with a cacophony of urgent, often contradictory information. Dire predictions of the next great market crash, breathless hype about the revolutionary new technology stock that you simply cannot miss. Financial advisors, often motivated by commissions, present you with an array of complex and opaque products, annuities, structured notes, and high-fee mutual funds that promise safety but often deliver mediocrity. And perhaps most dangerously, there is a powerful internal temptation, a gnawing fear that you have not saved enough, that whispers a seductive and fatal suggestion: you are behind. You need to catch up. You need to take more risk. This is the siren song that has lured countless retirement accounts onto the rocks of ruin, the desperate last-ditch gamble to make up for lost time. Into this storm of noise, complexity, and fear, we must introduce the voice of uncompromising rationality, a voice of profound, simple, and time-tested wisdom. We must introduce Charlie Munger. While his partner, Warren Buffett, is the celebrated public face of Berkshire Hathaway, Munger was its quiet architect, the intellectual co-pilot who provided the philosophical blueprint for the most successful investment operation in history. He was not a stock picker in the conventional sense. He was a master of worldly wisdom, a polymath who drew on the great ideas from psychology, history, physics, and biology to build a latticework of mental models for making rational decisions in an irrational world. Munger lived to the age of 99, and in his near century of life he witnessed every conceivable type of market environment: booms, busts, wars, technological revolutions, and periods of rampant inflation. He saw it all, and through it all his core philosophy remained a bedrock of simple, unshakable principles. His advice was not designed to make you rich overnight. It was designed to ensure that you would, with near certainty, not die poor. For the investor over the age of 50, whose primary goal is no longer a spectacular home run, but the absolute preservation of their financial independence, his wisdom is not just useful, it is essential. This is a masterclass in his philosophy, distilled into a single actionable approach. So what is the number one, most important piece of advice from the man who saw it all, the one principle that can serve as the most reliable and secure foundation for financial peace of mind after the age of 50? The single most important piece of advice Charlie Munger would give to an investor over 50 is not what to do, but what not to do. This is the great Munger mental model of inversion. Instead of asking the conventional question, how can I achieve high returns to secure my retirement? The far more powerful and useful question is, what are all the things that could possibly destroy my retirement, and how can I avoid them? As Munger famously said, all I want to know is where I'm going to die, so I will never go there. For an investor with decades of working life ahead of them, a major mistake can be overcome with time and future savings. But for the investor over 50, the equation is fundamentally different. Your accumulated capital is no longer just a scorecard. It is your life support system. A catastrophic, permanent loss of capital is no longer a setback. It is a potential life sentence of financial insecurity. Therefore, the primary goal must shift from an aggressive offense of return maximization to a disciplined, intelligent defense of capital preservation. Munger had a wonderful term for the common self-inflicted mistakes that lead to financial ruin. He called them standard follies. The first and most critical step in building a retirement-safe portfolio is to understand these follies and to construct an impenetrable defense against them. Munger held a deep and abiding disdain for the institutional financial services industry. He often compared it to a casino where the house, the brokers, the fund managers, the financial advisors, makes its money not necessarily from the success of its clients, but from the sheer volume of their activity. The house, or the croupier as he called it, profits from the churn. For the investor over 50, this churn is a silent, relentless, and devastating cancer on their capital. Consider the layers of costs that are systematically extracted from your portfolio. There are the management fees of mutual funds, often a percentage of your assets paid out year after year, regardless of the fund's performance. There are the trading commissions paid to brokers every time you buy or sell a stock. There are the hidden costs of bid-ask spreads. And perhaps most damagingly, there are the taxes on short-term capital gains, which are incurred every time a position is sold for a profit within a year. Each of these costs, taken in isolation, may seem small. A 1% management fee, a $10 commission, these seem like minor tolls. But Munger taught that you must think like a physicist and appreciate the power of compounding, both positive and negative. Over time, these seemingly small frictional costs compound into a massive, almost insurmountable drag on your returns. For a young investor, this is a handicap. For a 50-plus investor whose time horizon for compounding is now limited, it is a fatal wound. There is simply not enough time left to overcome the tyranny of compounding costs. The Munger-inspired solution is a radical act of simplification and inaction. It is to recognize that in the game against the croupier, the only winning move is not to play. This means minimizing your trading activity to the absolute bare minimum. It means avoiding high-fee, actively managed mutual funds and complex financial products that are designed to enrich the seller, not the buyer. It means understanding that one of the most powerful forces for wealth preservation is simply to sit still and let your capital work for you, undisturbed by the costly hum of constant activity. Munger's second great defense against ruin is the powerful concept of the circle of competence. The rule is simple. You must have the intellectual humility to know what you know, and to stay strictly within that circle. The world is full of thousands of publicly traded companies, but you are only required to have a deep understanding of a handful of them to succeed. For the investor over 50, this is not just a useful guideline. It is an absolute law of survival. The financial world is filled with seductive story stocks, companies in exciting, fast-growing, and highly complex fields like biotechnology, advanced software, or mineral exploration. These are often the very stocks that are hyped on financial television and in online forums. They promise explosive, life-changing returns. But they also carry an extremely high risk of a total 100% loss of capital. They are often burning through cash, have no history of profitability, and their success depends on a single scientific breakthrough or a complex technological development that is completely incomprehensible to a non-expert. To invest in such a company is not an act of investment. It is an act of pure, unadulterated speculation. It is a gamble on a future you cannot possibly underwrite with any degree of confidence. Munger's advice is to be ruthless in your self-assessment. If you cannot explain in simple terms how a company makes money, what its durable competitive advantage is, and what the key risks to its business are, you have absolutely no business owning its stock. As he famously said, it is not a sin to not know. It is a sin to think you know when you do not. For the retirement-focused investor, this means deliberately and systematically avoiding the vast majority of the market. Your goal is not to find the next great technological unicorn. Your goal is to find businesses so simple, so durable, and so understandable that you can have a high degree of confidence in their ability to be larger and more profitable a decade from now. This is a defensive posture. It protects you from the catastrophic losses that come from betting on complex and unknowable futures. The very losses a retirement portfolio cannot afford to sustain. A direct corollary to the circle of competence is Munger's profound preference for simple, understandable, and often boring businesses. The human mind, he observed, is often attracted to complexity, believing that a complex strategy must be a superior one. In investing, the opposite is usually true. Complexity is often a cloak for hidden risks, for overleverage, and for a fundamental lack of a durable business model. Consider the businesses that Munger and Buffett famously favored for Berkshire Hathaway: Coca-Cola, See's Candies, The Washington Post, American Express. These are not complex operations. Their business models can be understood in a matter of minutes. They sell simple, enduring products or services that have been in demand for generations. Their success is not dependent on a single patent or a revolutionary new algorithm. It is dependent on the timeless realities of human habit, brand loyalty, and simple, effective execution. For the investor over 50, simplicity is a synonym for safety. A simple, boring business is, by its very nature, more predictable. Its earnings are more stable, its future is easier to forecast with a reasonable degree of confidence, and there are far fewer ways for it to catastrophically fail. Contrast this with a highly leveraged investment bank with a multi-trillion-dollar derivatives book, or a pharmaceutical company whose entire future rests on the outcome of a single Phase 3 clinical trial. The potential for a sudden, unforeseen disaster in these complex businesses is exponentially higher. Munger's advice is to actively seek out the boring. Look for the company that has been doing the same simple thing, and doing it exceptionally well for decades. Look for the predictable, the stable, and the understandable. For a retirement portfolio, the goal is not excitement. It is a good night's sleep. And nothing is more conducive to a good night's sleep than owning a collection of simple, durable, and highly predictable businesses. The final great folly that Munger warned against was the danger of a rigid, ideological mindset. He had a deep contempt for people who became prisoners of a single idea, a man with a hammer, for whom every problem looks like a nail. He was a fierce critic of many of the dominant academic theories of his day, most notably the efficient market hypothesis. This theory, which posits that it is impossible to outperform the market, was, in his view, an absurd piece of ivory tower nonsense that was disproven by the very existence of people like himself and Warren Buffett. He saw it as a dangerous ideology that encouraged a passive index fund-only approach, preventing investors from ever benefiting from the market's occasional and wonderful fits of irrationality. But his criticism was not limited to academia. He was equally dismissive of any rigid, dogmatic market view. He had no patience for the permanent permabull who believes the market will always go up, nor for the permanent permabear who is always predicting the next great collapse. Both, in his view, were ideologues who had allowed a single narrative to blind them to the complex, ever-changing reality of the world. Munger's alternative was a flexible, pragmatic, and multidisciplinary approach he called a lattice work of mental models. He believed that to make rational decisions, one must have a toolkit of the big, foundational ideas from all the major fields of human knowledge: psychology, history, mathematics, engineering, biology, and so on. For the investor over 50, this is a crucial tool for survival. It means you must be a pragmatist, not an ideologue. You cannot afford to be a gold bug who believes a collapse is always imminent. Nor can you afford to be a tech utopian who believes that growth will continue forever. You must be able to look at the world as it is, to see both the opportunities and the dangers, and to act rationally based on the evidence, not on a preconceived political or economic bias. This mental flexibility is the ultimate defense against being blindsided by a future that will inevitably be different from the one you expect. Having built a strong defensive foundation by systematically avoiding the standard follies that lead to ruin, we can now turn from defense to offense. But this is not the reckless, speculative offense of a gambler. This is the patient, intelligent, and overwhelmingly powerful offense of a rational investor. This is the heart of Charlie Munger's entire philosophy, the single greatest piece of actionable advice that guided the creation of Berkshire Hathaway's multi-hundred-billion-dollar portfolio. His number one tip for building a retirement-safe fortune is this: own a small collection of truly great businesses, purchased at a fair price, and then do almost nothing. This simple statement is the culmination of a lifetime of thought and experience, and it represents one of the most important intellectual evolutions in the history of modern investing. To understand its power, we must first understand the great philosophical shift that Munger himself initiated. Warren Buffett's early career was built entirely on the principles he learned from his mentor, Benjamin Graham. Graham's method, forged in the ashes of the Great Depression, was a quantitative, almost brutal form of bargain hunting. He taught his students to search for companies that were trading for less than their net current asset value, what he called net nets. Buffett famously described this as the cigar butt approach to investing. On the street, you find a discarded cigar butt that has one good puff left in it. You pick it up, take that one last free puff, and then you throw it away. It is not a quality experience, but it is profitable. This meant buying mediocre, often struggling, but statistically cheap companies, holding them until the price recovered to a more reasonable valuation, and then selling to find the next cigar butt. This strategy was phenomenally successful for a time, especially in the fragmented and inefficient markets of the mid-20th century. But as Berkshire Hathaway's capital grew, the strategy began to show its limitations. Firstly, it was not scalable. You cannot invest billions of dollars in tiny, obscure, statistically cheap companies. Secondly, and more profoundly, it forced you to be the owner of terrible businesses. And as Munger famously quipped, a terrible business at a wonderful price is still a terrible business. Time, he understood, is the enemy of a bad business. It was Charlie Munger who was the great catalyst for change. He relentlessly pushed Buffett to evolve beyond the rigid, quantitative framework of Graham and to embrace a new, more profound idea. As Munger stated in what is perhaps the most important investment quote of the last 50 years, "A great business at a fair price is superior to a fair business at a great price." This was a paradigm shift. It was a move away from the one-time puff of the cigar butt and towards the long-term ownership of what Munger and Buffett would come to call compounding machines. Businesses of such exceptional quality that their intrinsic value would grow year after year, decade after decade. For the investor over 50, this is the single most important conceptual leap they must make. Your goal is not to find a series of short-term, statistically cheap bargains. Your goal is to identify and become a long-term, silent partner in a handful of the world's most durable and profitable enterprises, allowing their inherent quality to do the heavy lifting of securing your retirement. But what exactly is a great business? Munger provided a clear, rigorous, and practical checklist. Let us deconstruct it. The first and most critical characteristic of a great business is that it must be protected by a wide and sustainable economic moat. This is the metaphor Munger and Buffett used to describe a durable competitive advantage, an invisible barrier that protects a company's profits from the relentless siege of competition. In capitalism, high profits are a beacon that attracts a flood of competitors, who then drive those profits down through price wars and innovation. A great business is like a profitable castle, and its moat is what keeps the marauding armies of competition at bay. For the retirement investor, a wide moat is the ultimate source of safety and predictability. Munger identified several key types. First, there is the brand, or what is more broadly called an intangible asset. Think of Coca-Cola. The moat is not the secret formula in a vault in Atlanta. It is the billion-dollar piece of mental real estate that the Coca-Cola brand occupies in the minds of billions of consumers around the globe. This brand, built over a century of relentless advertising and consistent product delivery, creates an automatic, almost unconscious consumer preference. This allows the company to charge a premium price for its product, and ensures a level of demand that is remarkably stable and predictable through any economic environment. For a 50-plus investor, owning a business with a powerful global brand is like owning a royalty on a timeless human habit. Second, there is the scale or cost advantage. The classic example is Costco. Costco's business model is a masterpiece of scale, a self-reinforcing virtuous cycle. By selling goods in bulk from no-frills warehouses and marking them up by a razor-thin fixed margin, they offer their members the lowest possible prices. These low prices attract a massive and intensely loyal membership base. This huge volume of sales gives Costco immense buying power with its suppliers, allowing it to negotiate even lower costs. These cost savings are then passed back to the members in the form of even lower prices, which in turn attracts more members. It is a relentless, unstoppable feedback loop. A competitor cannot simply open a store across the street and compete because they do not have the scale to match Costco's prices. For a retirement portfolio, a business with a dominant scale advantage is a fortress of profitability. Third, there are network effects. This is a powerful moat that becomes stronger with every new user. Think of American Express. Its network has three sides: the cardholders, the merchants who accept the card, and American Express itself. The more high-spending cardholders that American Express attracts, the more essential it becomes for merchants to accept the card. The more merchants that accept the card, the more useful the card becomes to cardholders. This creates a powerful, self-perpetuating ecosystem that is incredibly difficult for a new competitor to break into. The network itself is the competitive advantage. And fourth, there are regulatory barriers and high switching costs. A regulated utility, for example, is often granted a legal monopoly to provide electricity or water to a certain region. This is a government-created moat. High switching costs occur when the pain, cost, or inconvenience of switching from one product or service to another is so great that customers are effectively locked in. Think of the complex software that runs a large corporation. The cost and operational chaos of switching to a new system are so immense that the company will continue to pay its existing provider for decades. For a retirement investor, these businesses offer a level of revenue predictability that is the very definition of safety. The second non-negotiable criterion for a Munger-style great business is that it must consistently generate a high return on the capital that is invested in its operations, and it must do so without using a large amount of debt. Let's demystify this concept with a simple analogy. Imagine two money machines. Machine A is a magical device. For every $1 you put into it to build and maintain it, it spits out 20 cents in profit year after year. This machine has a 20% return on capital. Machine B is a clunky, inefficient device. For every $1 you put into it, it only spits out 5 cents in profit. This machine has a 5% return on capital. Which machine would you rather own? The answer is obvious. Machine A, the high return on capital business, is a true wealth creation engine. It gushes cash. It generates far more money than it needs to simply maintain its operations. This surplus cash is the seed corn for future growth and shareholder returns. Machine B, the low-return business, is a capital-intensive slog. It consumes vast amounts of money just to stay in business, leaving very little left over for its owners. Munger taught that over the long run, your investment return will gravitate toward the underlying return on capital of the business you own. Owning a collection of high return on capital businesses is the surest path to long-term compounding, but Munger added a crucial and characteristically prudent caveat. This high return must be achieved without the use of significant debt. A company can artificially boost its return on equity by using a large amount of leverage or debt. But this is a fragile and dangerous strategy. It is like an athlete using steroids to enhance their performance. They may look powerful, but they are vulnerable to a sudden collapse. A business that is heavily indebted is fragile. It is at the mercy of its creditors in the credit cycle. A great business, in Munger's view, is a naturally strong athlete. It generates its high returns organically from the inherent superiority of its business model. not from the artificial stimulant of financial leverage. For the 50-plus investor, this combination is the holy grail. A high return on capital, low debt business is a self-funding, all-weather compounding machine. It does not need to constantly access the capital markets to fund its growth, and it is resilient enough to withstand the inevitable economic downturns and credit crises that destroy its more leveraged competitors. The third criterion moves us from the quantitative to the qualitative. A great business, Munger insisted, must be run by a great management team. And his definition of great had nothing to do with charisma, media appearances, or a visionary Jobs-like personality. His criteria were far more sober and far more important. He looked for two specific traits: honesty and rationality. Honesty for Munger meant a management team that was completely candid with its shareholders. He would read decades of a company's annual reports, looking for leaders who wrote their shareholder letters with clarity and frankness. He wanted managers who would talk as openly about their failures and their problems as they did about their successes. This was a sign of intellectual honesty and a deep-seated respect for the company's owners. He despised managers who used accounting gimmicks to smooth their earnings or who obfuscated their results with jargon and promotional language. Honesty was a proxy for character, and for Munger, character was a non-negotiable prerequisite for any long-term partnership. Rationality, however, was the even rarer and more important trait. For Munger, a rational manager was, above all, a master of capital allocation. He understood that the primary job of a CEO is to take the cash generated by the business and deploy it in the most intelligent way possible to create long-term value for shareholders. A CEO has 5 possible choices for the cash a company generates: reinvest it back into the core business, acquire other businesses, pay down debt, buy back the company's own stock, pay it out as a dividend. A rational manager, Munger taught, approaches this decision like a professional investor. They will only reinvest in the business if the potential returns on that new capital are high. They will only make acquisitions if the target company is of high quality and can be bought at a sensible price. They will only buy back stock if they believe it is trading below its intrinsic value. An irrational manager, on the other hand, is often an empire builder, a CEO who is obsessed with growth for its own sake, who makes foolish, overpriced acquisitions just to make their company bigger, and who destroys shareholder value in the process. For the 50-plus investor, finding a management team that is both honest and a rational allocator of capital is a profound source of safety and peace of mind. It means you have a partner at the helm of your investment who is working tirelessly, intelligently, and ethically to increase the long-term intrinsic value of your share in the enterprise. This is the final and most tactical component of the Munger method. Having identified a truly great business, one with a durable moat, high returns on capital without debt, and run by a rational and honest management team, the final step is to buy it at a fair price. This is another key point of evolution from the Graham philosophy. Graham was a bargain hunter. He wanted to buy $1 for 40 cents. He was looking for a wonderful price. Munger, on the other hand, understood that a truly great business, a true compounding machine, is so rare and so valuable that it almost never trades at a deep Graham-style discount. To wait for a wonderful price on a wonderful company is to risk waiting forever. Therefore, Munger was willing to pay a fair price. This meant he was willing to pay a higher multiple of earnings or book value for an exceptional business than he would for a mediocre one. He understood that the long-term growth in the company's intrinsic value would more than compensate for a less-than-bargain basement entry price. As he famously said, "It is better to have a partial interest in the Hope Diamond than to own all of a rhinestone." But fair does not mean any. This is the crucial distinction that separates the Munger method from the growth at any price investing that leads to speculative bubbles. It still requires the discipline of valuation and the patience to wait for the right pitch. And when do these opportunities to buy great businesses at fair prices appear? They appear, Munger taught, during times of broad systemic fear. During a market crash like 1987, or a financial crisis like 2008, the entire market is sold off indiscriminately. The great businesses are thrown out with the mediocre ones. This is the moment when the rational, long-term investor, armed with a watch list of great companies and a reserve of cash, can act. Opportunities also appear during times of company-specific or sector-specific trouble. A great company might face a temporary, solvable problem, a product recall, a short-term economic downturn in its primary market, or a foolish move by a competitor. The market, with its notoriously short attention span, will often panic and sell the stock down to a price that is far below its long-term value. This was the case with American Express during the salad oil scandal of the 1960s, a moment that allowed Buffett and Munger to acquire a huge stake at a fantastically attractive price. This final criterion ties the entire philosophy together. It combines the rigorous analytical work of identifying a great business with the patient, contrarian temperament required to wait for the rare moment when that great business is offered at a sensible price. This 4-point checklist is the practical, actionable heart of the Munger method. It is a powerful filter designed to help an investor eliminate 99% of the market and focus only on the small handful of truly exceptional, retirement-safe businesses that are worthy of their long-term capital. Having a rigorous 4-point checklist for identifying a great business is the analytical foundation of the Munger method. It is the hardware of the system. But as Charlie Munger taught throughout his life, the hardware is useless without the right software to run it. This software is the investor's temperament. It is the psychological fortitude, the patience, and the emotional discipline required to not only act on your analysis, but more importantly, to not act when inaction is the correct course. For the investor over 50, mastering this psychological game is not just an advantage. It is the final and most critical line of defense for their retirement. Charlie Munger's most famous and most crudely phrased piece of advice is also his most profound. He said, "The big money is not in the buying or the selling, but in the waiting." In his blunter moments, he would put it more simply. A great deal of his success came from his ability to sit on his ass. This principle is a radical and direct assault on the entire culture of the modern financial world, which is a culture of constant, frenetic activity. The financial media provides a 24/7 stream of breaking news, analyst upgrades and downgrades, and market-moving information, all designed to provoke an immediate reaction. The brokerage industry is built on generating trading commissions. The entire system is engineered to make you feel that if you are not doing something, buying, selling, rebalancing, you are being lazy or irresponsible. Munger taught that this is a dangerous and expensive lie. True investing, he argued, is much more like hunting than it is like trading. A great hunter does not run through the forest firing their gun at every rustle in the leaves. They find a strategic vantage point. They wait with almost infinite patience for the rare, magnificent prize to appear, and only then do they act with decisive force. For Munger, great investment opportunities were just like that prize animal. They were extraordinarily rare. To illustrate this, he and Buffett developed a powerful mental model, the 20-slot punch card. Imagine that at the beginning of your investment career, you are handed a punch card with only 20 slots on it. Every time you make an investment decision, every time you buy a new stock, you must punch out one of those slots. You have only 20 punches for your entire life. This simple thought experiment is a powerful forcing function for discipline and selectivity. If you knew you only had 20 decisions to make in your entire life, would you waste one on a speculative, hot-tip stock? Would you use a punch on a company you did not thoroughly understand? Of course not. You would treat each decision with the gravity and the intense due diligence it deserved. You would wait, for years if necessary, until an opportunity of such overwhelming quality and value presented itself that you were willing to permanently use up one of your precious few slots. For the investor over 50, this analogy is even more potent. Your punch card may have even fewer than 20 slots left. The time to recover from a mistake, from a wasted punch, is gone. This reality makes the discipline of inactivity paramount. Your goal is not to find 30 or 40 pretty good ideas to fill a diversified portfolio. Your goal is to find 3 or 4 truly exceptional retirement-safe businesses that you are willing to own for the rest of your life. This requires a level of patience and selectivity that is almost non-existent in the modern market. But it is the very bedrock of the Munger method for wealth preservation. The second great pillar of Munger's temperament was his belief in multidisciplinary thinking. He had a deep contempt for the man with a hammer syndrome, the tendency of experts in one field to see every problem through the narrow lens of their own specialty. To truly understand a complex adaptive system like a market or a business, he argued, you must have a latticework of mental models in your head. You must have a collection of the big foundational ideas from all the major disciplines: psychology, history, mathematics, engineering, biology, and so on. And you must be able to use them together to see the world as it truly is. For the investor, the single most important discipline to master is psychology. Munger was a voracious student of human misjudgment. He understood that the greatest risks in investing often come not from external events, but from the predictable, irrational biases that are hardwired into our own brains. He taught that you must have an internal checklist of these biases, like confirmation bias, the tendency to only seek out information that confirms our existing beliefs; loss aversion, the fact that $1 of loss hurts more than $1 of gain feels good; and overconfidence bias, and you must constantly be on guard against them. For the retirement investor, understanding these biases is a critical defensive tool that prevents you from outsmarting yourself. He also drew powerful analogies from engineering. A great business, he would argue, must have redundancy, just like a well-designed bridge. It cannot have a single point of failure. It must have multiple sources of revenue, a strong balance sheet that can withstand unexpected shocks, and a moat that is so deep that it has several layers of defense. From biology, he understood the power of evolution and ecosystems. A great business with a durable moat is like a dominant species that has perfectly adapted to its ecological niche, making it incredibly resilient to new competitors. He understood that business, like nature, is a process of survival of the fittest, and his goal was to own only the fittest and most adaptable of species. For the 50-plus investor, this multidisciplinary approach is not an academic exercise. It is a powerful tool for robust risk assessment. It allows you to look at a potential investment from multiple angles, to see the hidden risks that a purely financial analysis might miss, and to build a more resilient and anti-fragile portfolio. The final and most practical tool in Munger's psychological toolkit is the principle of inversion. We introduced this in the first section as a grand strategy for avoiding ruin, but it is also a powerful day-to-day mental habit for analyzing any specific problem. As the great mathematician Carl Jacobi said, invert, always invert. Before making any investment, the Munger-trained mind does not start with the question, how much money can I make from this? It starts with the exact opposite question, how can this investment lead to a permanent catastrophic loss of my capital? You become a pre-mortem examiner. You assume the investment has already failed spectacularly, and you work backwards to figure out all the ways it could have happened. You actively and ruthlessly try to kill the company in your own mind. What new technology could make its product obsolete overnight? What change in consumer behavior could destroy its brand? What regulatory action could cripple its profitability? What single foolish acquisition could saddle it with a mountain of value-destroying debt? This process does two wonderful things. First, it forces you to confront all the potential risks of an investment head-on before you have committed a single dollar. It is the ultimate antidote to the confirmation bias that makes us fall in love with our own ideas. Second, if, after this ruthless attempt at intellectual murder, you cannot find a plausible way to kill the business, you have likely found a truly durable and resilient enterprise. For the retirement investor, whose primary job is to avoid stepping on financial landmines, The habit of inversion is the single most effective metal detector they can possess. The number one retirement-safe investing tip from Charlie Munger is not a secret trick or a hot stock pick. It is a complete and holistic philosophy, a way of thinking and a way of being. It begins with the profound act of inversion, a relentless focus on avoiding the standard follies that lead to ruin. It then transitions to a patient and highly selective offense, the identification and purchase of a small number of truly exceptional, simple, and understandable businesses that are protected by durable economic moats. And it culminates in the most difficult and most powerful act of all, cultivating the temperament to sit patiently, for years and decades, allowing the magic of compounding to do its work, undisturbed by the market's manic depressive noise. This is not a strategy for excitement or for getting rich quick. It is a strategy designed for the two things a 50-plus investor values above all else: prosperity and peace of mind.